Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Lyn Alden. And Lyn applies her background as an engineer to finance, which I think is really very valuable, a very valuable discipline to apply to economics and finance. I say that because markets do, in fact, have limits. It is particularly fashionable, especially these days, for politicians to suggest that feelings, if we just feel a certain way, markets will obey our feelings, and we can just sort of divine things as we so wish, rather than really respecting the limits of markets. And so, as an engineer with her engineering background, I know Lyn really approaches markets in a very systematic, logical manner, and she does a lot of great things, a lot of great thinking, and helps us understand the markets. So I'm really glad to have her with me again. Before I say hello, I should tell you, you can follow her work if you go to Lyn Alden, Lyn Alden, Alden, lynalden.com. She has a lot of really great free stuff. I want to talk to her today. The title, the subject that we're going to talk about today was from her recent article that was titled Interest Rate Effects on Equities, Valuation Impacts, and then she just also wrote one on the impact of, she called it the Japanification, not what you think. And if there's time, I want to ask her about that as well. But Lyn, thank you so much for joining me again.
Hey, thanks for having me back.
It's really good to have you. And I want to ask you, want to focus a little bit on, mostly on your interest rate effects. And, because people sort of have had this feeling that the central banks have our backs as equity holders. We don't have to worry. I mean, every time there's any kind of a substantial decline in the equity markets, in comes the Federal Reserve, pumping in huge amounts of money, lowering interest rates. Interest rates decline, which makes stocks more attractive than they would be under a higher interest rate environment. I'm a lot older than you. I remember Mrs. Taylor and I bought our first house. We had a 17.5% mortgage. Paul Volcker had just raised interest rates because we had a big inflation problem in the 1970s. And he was able to raise rates at that time, and he did, and it was very painful. We had the deepest recession, or the deepest recession. It was certainly a painful stock market collapse at that time. But it set the stage for decades of lower interest rates and growth and so forth. So I kind of remember that time, and I'm thinking back on it and wondering how much further can interest rates decline. And, there was a book I read called Beating the Dow with Bonds, Michael O'Higgins. In fact, I started following his methodology and found that you could make a lot more money in the bond market for quite a while, most of the time, than in the stock market after that time, because, obviously with rates falling from those high levels, you could make a lot of money in just by owning treasuries. And so I'm just wondering, do you think that this game is about over? I mean, we're almost at zero. We've ticked up a little bit on the 10-year. In fact, it's going up quite a bit recently. But what are your thoughts now? Is there still possibilities of making money after you take the impact of inflation away from the equation? Is there still a possibility of making money by owning treasuries?
No, I think a lot of them are facing issues for the next several years. And so we're already starting to see, for example, that the long end of the treasury curve actually is bouncing pretty hard. From the summer lows of 2020, we've had a pretty persistent rise in treasury yields. And in fact, the 10-year just hit 1.3% today. It's been a really big jump. And so we're starting to see a rise there, although it's interesting because it's still below the TIPS market, their inflation expectations. And so there's potentially still further to go up. And that could certainly put pressure on equity valuations, especially the higher valued growth tech names. Because as I discussed in that article, if you look at, say, highly valued growth stocks, and you do discounted cash flow analysis on them, so kind of old school valuation method by estimating their forward cash flows and then discounting them and summing them together to come up with a fair valuation. What makes a growth stock different from a value stock is that a growth stock, more of the cash flows are expected to be in the future because right now they might be small or they might be medium sized, but you expect them to grow considerably in the future, and that's where a lot of their results are going to be. Whereas the value stock is cheaper, slower growing, and more of the cash flows are upfront. And so that makes the growth stocks particularly susceptible to your interest rate that you use for the model, that you discount those years and potentially decades of cash flows. And so as you see the rates go back up, that can put a lot of pressure on some of these extremely highly valued software names and things like that, because we're often trading in many cases at 40 times earnings, 50 times earnings, sometimes more. And so if we get higher yields, which lately we have been, so far the equity market shrugged that off, but I think it's getting somewhat close to, kind of a decision point for equity markets where it's going to be harder to justify some of their extraordinarily high valuations as yields keep rising.
Well, I think probably, I guess that's why people don't use that sort of discounted cash flow, because the number's so small on the denominator. I mean, once you start, if you had 10% rates to discount future cash flows, big difference. And so, but most people, I'm guessing most equity market players are saying, well, we don't really ever have to worry about rising rates again. The Fed has our back. They can always pump more money into the system. Are they right in thinking that, to the extent they are?
To a certain extent. And so I think that, the Fed is going to have a decision point in a year or two ahead because they do have tools to prevent the long end of the curve rising. And the last time they used those tools was the 1940s when we had a similar fiscal debt situation and high inflation due to all the deficits used to fight the war. And so basically the Federal Reserve, they have one of two options. One is they can keep doing what they're doing now, which is, they're holding the short end of the curve down near zero, but they're letting the longer end of the curve rise. Now, they're still buying some of the Treasury, so they're kind of slowing it down a little bit, but they're mostly letting it rise to a certain extent. Or if it reaches a problematic level, they could go in and peg the long end of the curve with yield curve control by being willing to buy any Treasuries that try to go above that level. But the downside there is that they pretty much fully give up their independence. And so they've actually talked about that in their meeting minutes, where they've put that option on the table. They've discussed it, but they've also discussed the risks doing it. And so that's not an option that they want to jump to. And it would probably take a lot of market turbulence to make them go forward with that, because that goes against a lot of the things that they want to do. And so I think that's it's a pretty decent end game scenario to be aware of. But I don't think it's a linear line from here to there. I think they kind of like in late 2018 or late 2019, markets have to go through some degree of turbulence and find some issues before the Fed would be kind of forced to intervene in that way.
What do you think is causing rates to tick up right now? The Fed is still pumping a huge amount of money into the system, aren't they?
They are, but if you look at inflation expectations, normally 10-year Treasuries are above the 10-year the TIPS markets inflation expectations, and over the past year they've been considerably below the inflation expectations, in large part because the Federal Reserve has been the biggest buyer of those Treasuries. But they bought a ton of Treasuries in early 2020, and they bought almost $2 trillion worth of Treasuries in a 6-month period there in early 2020. But since then, they've been buying at about $80 billion a month rate, which is about $1 trillion annualized, which sounds like a lot until you take into account the fact that the amount of Treasury issuance last year was $5 trillion, and if we include a $1.9 trillion stimulus this year, and along with a $1 trillion kind of base deficit, and you kind of add that up, you're potentially looking at another $3, $4, $5 trillion in issuance this year. And so that's actually a lot of Treasuries for the private sector to absorb. And so if the Fed continues on their current trajectory of purchases, supply and demand characteristics should point to somewhat higher Treasury yields. And so that's where we get some of these issues for the equity market. And that's also to some extent what's been leading gold to consolidate over the past 6 months or so, is that because gold closely tracks real rates, and so even though we've had rising inflation expectations, we've also had rising 10-year yields that have kind of kept gold in that somewhat kind of a mild downtrend, that kind of corrective stance after a very strong 2018, 2019, and early 2020.
Well, when you talk about gold, I have to ask you about Bitcoin. I was going to save that for later in our discussion, but what's driving Bitcoin?
So Bitcoin's going through its adoption cycle, and this, Bitcoin kind of operates on its own unique timing because every 4 years, the number of new Bitcoins gets cut in half. So Bitcoin generates a certain amount of new coins every 10 minutes, and every 4 years, that's pre-programmed to get cut in half. And so that happened back in May 2020. And if you look at the historical chart, Bitcoin generally does very well for the 12 to 18 months after one of its halving events. And so lately we've been in kind of the heart of that bull market, and so it actually looks a lot like how it looked back in 2017 and also how it looked back in 2013. And so it's going through that kind of 4-year cycle. And so by most metrics, if you look at on-chain indicators, it's showing that it's maybe halfway through that cycle. But of course, history doesn't repeat perfectly, and so it still has to be monitored for risks. But overall, I think it's going to have corrections and things like that, but it's still somewhat on track to do pretty well, I think, in 2021. But at this point, because it's risen so far, people that have been investing, since, over a year ago, they might want to rebalance. They might want to, kind of shift things into their other assets so they don't become overexposed to something that, might have gone up 3x or 5x or more for them.
Yeah. I wasn't aware of this halving aspect. I was aware that Bitcoin had its limits on how many could be produced, but I wasn't aware. So you're saying every 4 years, the quantity gets cut in half?
Yeah, that's how it reaches its 21 million cap. So, in the first 4 years of its existence, every 10 minutes, about 50 Bitcoins were generated. And that's from the mining activities. To basically, the miners verify Bitcoin transactions, and their reward for doing so, in addition to transaction fees, is they get to create those newly generated Bitcoin. And so the number of Bitcoins started at like 0, and then it ramped up by 50 more Bitcoins every 10 minutes. But then after 4 years, that was pre-programmed to reduce to 25 Bitcoins every 10 minutes. And then 4 years later, it went down to 12.5 Bitcoins every 10 minutes. And after this latest halving, it's down to 6.25 Bitcoins every 10 minutes. And so as long as demand remains relatively persistent, if new supply gets cut in half, you tend to get a supply shock. And so much like other commodities, that tends to result in a bull market and a higher plateau for the next Bitcoin price. And then, of course, momentum traders jump on board and you get this big blow off top. And we've seen that actually in every one of these 4-year cycles where it kind of ends with this big blow off top and then a correction and a consolidation until the next halving happens again and kind of repeats the cycle, 4 years later.
I guess that's something people should really be aware of then and paying close attention to, obviously. I guess that's why people are really reading your stuff, because you're keeping us aware of those kind of very important fundamentals that I wasn't aware of until now. Well, getting back to interest rates, do you see any prospects at all of negative nominal rates in the United States?
So we're starting to see that there might be an issue where there's kind of a shortage actually in some cases of T-bills, and because a lot of institutions need T-bills, and so they've actually been pushing those pretty low, even though the longer end of the curve is going up. And so that might cause the Fed some technical issues, but overall they don't really show signs of wanting to go negative, and that makes sense because there's really no evidence that negative yields are kind of beneficial to anyone. And so Europe and Japan have done them to try to weaken their currency against the dollar, but overall it's not a very good monetary policy, and so the Federal Reserve seems aware of that, and so my base case is more like they're holding yields at 0 while letting inflation, kind of do what it's going to do over the next couple of years. And they've shown their willingness to let inflation run hot because they changed from kind of using 2% inflation as their ceiling to targeting to actually purposely try to get it over that.
Well, they use I guess they use our government's numbers for inflation, don't they? They use 2% would be the CPI, I suppose, or.
Yeah, they use the PCE, which is one of their. It's similar to the CPI, and so based on their measurement, they're trying to overshoot 2%, and so based on the way they measure it, they'd probably get concerned if that hit 4%. But when it's in that 2 to 3% range, they're actually kind of targeting that. Whereas according to the way they've measured it, inflation's averaged maybe 1.5 to 2% over the past 10 years.
So they can always change that basket of whatever it is they use to measure that too, right? The government
Yes.
does from
Yep.
time to time. Hedonic pricing and substitution, all kinds of tricks they pull over the years to get the numbers they want. As you know, somebody's receiving my Social Security is of some interest to me. I don't think that my costs are going up only 1.5%, but that's another issue. I wonder, do you see any prospects for inflation running so hot that people start losing confidence in the Fed or in the dollar, or the dollar starts to get hurt, and the Fed could possibly lose control of inflation? I mean, in the 70s, because I was a very young man then, I remember, first they just pumped huge amounts of money, the Federal Reserve Chairman G. William Miller and Arthur Burns, and then you started having this massive amount of inflation. Of course, you had the oil issues back then, OPEC and that sort of thing that came into play, but the government dumped the Fed created huge amounts of money, and for that time, it looks like nothing compared to the numbers they're putting out now. But it seemed as though the Fed was kind of behind the curve, and interest rates would go up. They pumped more money in the system, but it was never, it wasn't until Paul Volcker slammed on the brakes in 1980 that they got control of things. But it seemed to me that the Fed lost control of interest rates, and inflation. Do you see that possibility happening again?
It's a possibility, and there's a couple of variables to watch. And so one of the tightest correlations is that the growth in the broad money supply is pretty correlated to consumer price inflation, even the official way they measure it. And so if you look back over the past century, there have been two inflationary decades in the United States, and so that's the 1940s and the 1970s. And both of those saw a big growth in the money supply, and they both saw a growth in inflation. Now, lately, what we've been seeing is we saw a very sharp growth in the money supply, but the inflation level, by the way they measured, is still somewhat on the low end, and that's somewhat been held down by lower rent prices in certain cities, because of issues related to the pandemic, and also because we've had this period of commodity oversupply, particularly energy, and so in many cases, commodities are the same prices they were 10, 15 years ago, like especially energy again, and so that's really kind of kept a lid on kind of really broad inflation. But I think going forward, if you were to continue to get this significant broad money supply growth at the same time as if we start to run into notably higher commodity prices due to kind of where we are in the commodity cycle, and so if there's not a lot of new interest in say new drilling, there's not a lot of maybe new money going into capex for energy projects, and there hasn't been a lot of new major copper discoveries, for example, in the past several years. And so if you start to get tight on some of these commodities in a way that we've really not seen over the past decade, combined with that broad money supply increase, that's when you can get actual kind of pretty much any way they measure it, inflation.
So interest rates would start to rise, or at least that would be if they were allowed to rise. Interest rates would start to rise, and the government now having such an enormous amount of debt would see interest expense just absolutely go nuts. It would just go exponential almost. If you started having what is the government's debt now? It's 27 trillion or something like that, right?
Yeah, it's getting close to about 28 trillion. And so they'd have a choice to make. If you go look at those two inflationary decades, in the 1970s, as you point out, they raised interest rates to quell inflation. And the reason they were able to do that is because debt levels were very low, both in the public sector and the private sector as a percentage of GDP. On the other hand, if you look back in the 1940s, the public's debt was huge. That was the only other time we had 100% the GDP federal debt levels like we have now. And so what the Fed did was inflation ran hot for several points in that decade, and they still kept the short end and the long end of the curve pegged below that inflation rate. And so it's kind of a choice between letting higher yields kind of result in a big fiscal problem for the government, or kind of killing the dollar, because if they hold, there's no free lunch. So if they hold rates below the inflation rate, the release valve is the strength of the currency. And if they let yields rise, it can keep the currency, from weakening too much, but it starts causing a fiscal problem for the United States due to that higher interest rate expense on their, 28 trillion in debt, probably 30 something by the end of this year.
Yes. It's mind-boggling for an old guy like me, I'll tell you that. I just noticed there was something. Bank of America's chief investment officer, I think his last name is Hartnett, has expressed concerns that real inflation, as opposed to financial inflation, he's expressing those concerns. He's suggesting that the velocity of people and velocity of money will be in the rise with vaccines and an increased mobility of people. In other words, as things get back to normal, assuming the vaccines are effective and the pandemic becomes less of a problem, he sees velocity of money, he sees things picking up, and a real prospect of inflation. So I just wondered if that's something you think we should be watching for, and if so, I suppose we should be owning commodities and precious metals and that sort of thing, right?
Yeah, certainly. Certainly it's something to be aware of, because as you've seen the broad money supply go up, part of the reason that inflation was kept in check over the past year was because velocity fell down. And the interesting thing is about velocity, you don't even necessarily need high velocity for inflation. Like if you look at the 70s, velocity wasn't really higher than the 60s. It's just that it wasn't falling at the same time as broad money supply was going up very dramatically. So if velocity stabilizes or starts going up at the same time as broad money supply is increasing, then yeah, you could certainly get somewhat of an inflation spike, especially because we've had scarcity, kind of supply chain issues and lower capital expenditures for some of these things, and so that's certainly a risk to be aware of. So I've been bullish on commodities. I've been also you can kind of play it, depending on what kind of investor you are. You can short the long end of the Treasury curve, for example. You can bet on somewhat higher rates. So, for example, Stanley Druckenmiller gave a great interview the other day where he showed that he's kind of positioning for it regardless of what the Fed does. So he's short Treasuries, but he's also long commodities. And so if the Fed kind of intervenes and keeps rates from rising, but inflation is still present, then his commodities position would likely do very well. On the other hand, if the Fed does let yields rise pretty far, that could keep somewhat of a lid on commodities by maintaining some dollar strength. But his short Treasuries position would do very well, and so he's kind of positioned for that. And I think that's a smart way to play it, is to be positioned for some degree of higher inflation, but then be mindful of the fact that the Fed could intervene in a couple of different ways as it relates to nominal interest rates.
Oh, that makes sense to me. I guess maybe in wrapping up here, Lyn, we're just about out of money. I'm not out of money, out of time. I think time is money. That's the old saying. I guess then what you're saying is if we have rising interest rates, then probably growth stocks are not so much, and we want to go more for the traditional cash flowing instruments, cash flowing stocks probably, as opposed to a low interest rate situation where growth stocks are favored.
Yeah, exactly. That's what I'm favoring. I'm favoring some foreign equities, some value equities, some commodity producers, things like that, although I'm still kind of emphasizing quality. So ones with strong balance sheets, ones that actually have, say, low-cost production, whatever the case may be for that particular industry that we're talking about. But I think that kind of value/quality, mix, I think is pretty important going forward.
Yeah, absolutely. And you do have a service in which you share more specific investment ideas that people, a very reasonably priced service, I might add. And it's LynAlden.com where folks can go for that. And also, you can read her latest article, Economic Japanification, Not What You Think. And I guess we don't have time to ask you about that, Lyn, which means that people need to go to your website to read about it. Maybe we can have you on sometime soon to talk about that article as well. I want to thank you so much for being with us again and sharing your insights. Very valuable. Always great to have you with us. And I hope we can do it again sometime soon.
Yep, always happy to be here. Thanks.